Hello, friends. I hope I'm audible. Yeah, so I think I'm audible. So welcome to this paper review for SFM, CFA. I hope I'm audible. Yeah, welcome to this paper review for CA Final SFM of November 2022 exams. The exam concluded yesterday. So the paper, if you honestly look at it, came out, you can say, it was pretty easy. I would say it was easy. There were one or two questions which could probably be, marked as slightly tricky, but I don't think there was any element of, googlies or trick questions or anything like that. Okay. So, so let us start off right away and, let me take you through in the next 5 to 10 minutes how the paper was. Right. And believe me, friends, this is one paper which has got significant amount of questions from what we solved in the class. So if you had solved all the questions that we have solved in the class, we have roughly about 500 odd questions. If you have solved all the questions, or even if you have not done that, but you have attended the, revision sessions, a couple of revision sessions have been uploaded on YouTube. And we also gave important questions. We have released important questions list on YouTube. If you've gone through either of them, you would actually, be in a position to score very high marks. Okay. Theory slightly here and there, could have appeared tricky, but I don't think that was the case. If you attended our classes at OneFin, I'm pretty sure you would have understood everything in depth, even though you may not have been actually be able to replicate word to word what institute wants or what is there in the study material with respect to theory. But I am pretty sure you would have actually been able to write the essence of what I've actually taught in the class. Okay, so without wasting further time, let us just get into write the paper review. So what I have here is first a summary of how the paper was. Right. So if you look at this summary, right? If you look at this summary, so I'm going to highlight this. Theory questions, roughly about 32 marks of theory questions came in. Now, when I say 32 here, one odd question where they gave choice and all that also, I've actually included that. Right. So 32 marks of theory questions came, and roughly about another how much balance marks that came in from your practical questions. And theory, if you look at it, right, there's one, there's actually two chapters from which no question came in. Actually, you see this chapter, security analysis, and here mutual funds. Both these chapters, there was not even a single question. So there were some questions in portfolio management where they covered aspects of mutual funds, but there was no direct mutual funds question. So that is something very interesting in this paper. But, and you know what is even more interesting? This chapter called portfolio management. Roughly 32 marks worth of questions actually came from portfolio management. That is, I know I wouldn't actually expect that. I know portfolio management is a fairly important chapter. I've told you multiple times and all of that, but I was not actually expecting 32 marks. But believe me, anyone who's well versed with portfolio management chapter would be easily able to crack it. Okay, and we had then questions from some one theory question from first chapter, then risk management VAR related question. Then you had security valuation, equities, security valuation, fixed income, the debt and bonds, securitization, there was a standard question, so on and so forth. So then every other chapter has been covered. Right. So now, I've just given you a brief. And in fact, if you see here, this column number 2, right? Let me highlight it with a different color. So you see this column number 2, what I'm highlighting now. These are actually the question numbers that we solved in the class. Okay, I'm giving you specific question number what we solved in the class. The question that is asked in the exam is either very similar to this question or is almost same question. So I have highlighted that also. New questions are roughly 24 marks. Same to same ditto questions are 8 marks, and similar questions are roughly 60 marks. So 60 marks worth of questions are similar. Okay, and 8 marks worth of questions are ditto, straight from what we have solved in the class. And 24 marks is new questions, but these are also very simple. Okay, so without further ado, let us just get into the question paper and see what are all these questions. Okay, so the first one is a question from M&A chapter. Okay, M&A is super simple. This is question number 66 and is in fact also a question from ICA study material, and we solved this in the class. We specifically solved this in the class, and ditto, there was not even a change in single number in this. Okay, that was what was slightly astounding to actually notice. Okay, then this is a fairly simple one. There are two companies. One is one is acquiring the other. What will be the equivalent earnings per share? What is the market value of the merged firm? So on and so forth. Then this is the new part. And again, you see, if you've understood the entire question, right, these new elements in these questions will be very easy to handle. Okay, even we have seen this in the May 22 paper also. They gave ditto steady middle or ditto what we have solved in the class questions. And for that, each one of them, they added one extra line as twist. Okay, that twist is also nothing major. It is just an additional part of the question. So like that, they have asked you some question and you've got to give an answer. And this is more likely than not, the answer for this is dependent on the previous 4 or 5 steps here. A to E steps are there, right? So if you go through all of those steps, you'll actually get answer to this part. Okay. Now, next question is Mantra Limited is planning to buy Ajay Limited. This is a corporate valuation question. And we have a very, very similar question. The numbers are slightly different, but the question is very, very similar. And it is similar to question number 12, illustration number 12, what we saw in the class is also actually a steady material question. We solved this in the class, okay, and it is fairly simple. There is actually nothing complex in this particular question. Everything was super simple. Okay, next coming to part C of the first question. This is a compulsory question, right? So briefly explain asset liability management. You remember I explained to you what is asset liability management. Banks, they try and ensure that the duration of their assets is similar to the duration of liability so that they never run out of money, or they always have money equivalent to meet their liability duration, and so on and so forth. We discussed a brief bit about that. So if you've attended my class and even if you've just heard the word, right, you would actually have, I am sure you would have at least remembered this particular part. Okay, next coming to next one, MNO Limited, a company based in India, high quality furniture, Nepal. Moment I saw this Nepal, right, I realized that I had seen this question somewhere. So it is very, very similar to illustration number 10 of International Financial Management chapter. This is also again a question straight from study material. We have solved this in the class as well. Okay, there are just some numeric changes here and there, some minor changes, but beyond that, it was actually a straight, very, very simple straight question. Okay, then what else? Then next question, part B of question 2 is, this also is a super simple question. This is from Forex chapter. They've just asked you what are the forward rates, how many dollars should I sell, how many rupees are required for dollars. It is like a cakewalk, boss. This is like a lollipop. If you honestly ask me, this is a lollipop question. It is similar to question number 40, illustration 40, what we solved in the class. Is also very similar to a steady material question. Okay, then explain various methods of hedging of interest rate risk. How do you hedge interest rate risk? You have, interest rate futures, you have interest rate options, then you can enter into forward rate agreement, then you can enter into, you've discussed multiple varieties of measures of managing interest rate risk. We have collars, caps, then we have a bunch of stuff. You go to the material, right? We've actually discussed how you can hedge your floating rate risk, how you can hedge your fixed rate risk. Bunch of these stuff we've actually discussed in depth. When I was actually discussing this, I covered this in adequate depth. Okay, then coming to 3A. This is a question on derivatives. See, and the funny part is, first 3 questions, there's no portfolio. Portfolio suddenly comes up. We saw that, right? 30 marks came out of portfolio. All that came later. So if you look at this derivatives chapter, this is straight illustration 12. This question is also very, very similar to the question what is given in illustration 12 from derivatives chapter, what we solved. See, when I'm saying illustration 12, these are illustration 12 from our OneFin's notes and OneFin's classroom lectures. Okay. So this also is a very, very simple one. There is nothing complicated in this chapter or in this particular topic. In fact, I have covered this kind of questions even in my derivatives revision also. Okay. Then part B is Srinidhi is learning portfolio management techniques, and you're supposed to compute constant portfolio. Where is it? Constant ratio plan versus a buy and hold plan. This also problem, if you remember when I was solving it, I was telling this is a very interesting question and appears to be an important question. I had told you, and this also is from portfolio management chapter. This is very similar to illustration 77, what we solved in the class. Okay, friends. So if you see, we are in question number 3, right? 3B. So far, every question is either has been solved in the class or, something very, very similar has been solved in the class. Okay. Next, what is the next one? This is portfolio management question, and this is a slightly new one. Okay, when I say slightly new, the reason is if you understood the concepts of portfolio management and what we have discussed, this is not at all a difficult question. This is not at all a difficult question. What have they given? Just have a look at this, right? This is question 4A. There are 3 mutual funds. They have returns over 3 years. and correlation between market and mutual fund is given, and variance of the market is given, risk-free rate is given, you are required to find out the Sharpe ratio and tenor ratio. What the Sharpe ratio, I told you, S stands for standard deviation, beta, T stands for tenor is beta. So you divide, the denominator is beta. So you know the formula for Sharpe ratio and tenor ratio. That much I pretty much assume. Now, after that, what? How are we going to find out the expected return of all these three mutual funds? It is very simple. You have these three, funds returns, historical returns. From that, you can find out the average returns, standard deviation, so on and so forth. Then after that, you have the correlation with the market. If you have correlation with the market, what can you do? Once you know correlation with the market, you can actually find out the variance of the market is also given. So you can actually find out standard deviation of the market. You know correlation of the market, you know standard deviation, then you know the standard deviation of each of the funds returns. What can you find out? You can find out beta. If you can find out beta, then what will you do? With beta, you can actually find out the expected return of that particular mutual fund. So from the expected return, you subtract the risk-free return divided by the, in case of Sharpe ratio by standard deviation, in case of tenor ratio by beta, you'll actually get the ratio. It is a super simple question. It just requires simple application of mind, nothing fancy. Okay, now let's go to the next part. Illustration 24. This illustration 24, this is actually question 4B, right? 4B is very similar to illustration 24, what is taught in class. This is from portfolio management chapter. Here also the numbers are just one or two numbers changed, but other than that, the question was very simple. And here, is there anything complicated in this? No, this is a new part which is not there in illustration 24, but I don't think that is also anything, slightly, I don't think it's anywhere complex. It is just that you have to figure out what is the right mix of securities. And for both the scenarios where, the market return is 10%, market return is minus 5%, what is going to actually happen to the return of the portfolio. Okay, that's all. Then features of securitization. This we have discussed multiple times. There is what happens in securitization. You move, assets are, it gives liquidity to the person who's securitizing, so on and so forth. And then, you have things about, it allows that person to parcel off stuff. Then there is, there are multiple people involved. There is rating. We've discussed a lot of things about securitization as well. This is also fairly simple one. Okay. Then coming to 5A. Here also again, there are three companies, 4 years of returns are given. This is a portfolio management question. This is also slightly new one. But again, you can actually, create it. You can actually solve this very easily. What does it say? Construct maximum number of portfolio. Its return portfolio consists of any two shares in proportion of 65 and 35. So you take the average return. From that average return, you compute, ensure that, create multiple portfolio. How many portfolios can you create? A, B, and C are there. So you will do A plus A, B, A, C, and B, C. So you'll only have 3 portfolios. From those 3 portfolios, you have the ratios in 65 and 35. So you keep changing. So 3 into 2, you will basically get 6 portfolios. Simple, right? So far, so good. So you should not unnecessarily get confused. Calculate the portfolio return beta if X invest so-and-so in A having beta of so and so. It is a very simple question. There is nothing complicated in this. Believe me, it is a super simple question. Just that you have to keep mind calm and move forward. Then let us move to the next one. Books of Murugan Limited. This is a straight, almost ditto. Okay, by the way, this is not the same question, but almost. I think they've changed one number, the marketable price, market price of the convertible bond and current price. A couple of things they've changed. Otherwise, this is a question number, illustration number 31, what we solved in security valuation, bonds or fixed income chapter, right? So there is nothing different in this question also. Okay. Then what is bootstrapping? Explain method of trade used by startup firms in bootstrapping. Bootstrapping is what I told you also. You tie your shoe, pull yourself up, and all of that. So basically, you're trying to raise or run your business by using your own money instead of using raising any VC funds or using money from anybody else. And how does trade help? Basically, you take longer duration credit from people who are your who are your suppliers. You don't pay them immediately and use that money, reinvest that particular money in your existing business and then grow. That's all. It is very simple. Then last question. This is a slightly newer question, but I don't think it's anything complex. Mr. X wants to invest 1 lakh in 7-year 8% bonds, which were issued 2 years ago. So it is 7 years bond, already 2 years over, balance 5 years maturity. You're required to advise him what is the maximum price to be paid. If he's expecting minimum 9% return, minimum 7% return, similar bonds are at 8.25, similar bonds are at 7.75. Okay. If the bond yield, if bonds are available at par and 1% transaction cost, what is effective yield? Find the number of days required to break even transaction cost. The bonds are available at par and 2% the transaction cost. Because other than this last part, which you may have not heard, others are very simple. It is simple cash flow. You 8%. You know the coupon, so coupon cashing. You know the inflows from coupons, right? Then minimum expected return. Then you discount by that. Then what is the price. You can compute the price in both the cases. Then if the present rate of similar bonds is 8.25 or 7.75, you should use that as a discounting rate. So it is very, very simple. Okay, there is nothing complex even in this particular question. Then coming to last part, what is sustainable growth rate? This actually is covered in chapter 1, where we discuss what is sustainable growth rate. It is there even in subsequent chapters. I think even in the last corporate valuation chapter also, it is covered in brief. It's nothing that the formula, right? What is sustainable growth rate? What we use, G is equal to the ROE into whatever is the retention rate. So you have to actually got to explain that. And then what makes an organization sustainable? This also we discussed. It has, it is strong in terms of it has good product, good customer base. You have, strong, infrastructure, relationships, then good management. We discussed a bunch of things. All this also we actually discussed. So this is also the fairly easy one. So here they've given 2 questions, so 2 marks actually. Both of them we can actually take from the first chapter only. Then coming to the last question, this is again a super simple question. This is a question on sustainable growth rate. This is actually part of the security valuation chapter. We have done a illustration 11, very, very similar question we have solved in the class. Okay, now that's it. No, there's last another question. What short note on venture capital fund? Venture capital fund is someone who pulls money from people and then goes and makes an investment in startup companies which are actually expected to grow faster. And it's a private investment. It is not in public. There are a bunch of stuff we discussed: offshore fund, onshore fund. And then we discussed about this in enough depth, and I told you about what are the VC funds that are there in the country and so on and so forth. Then applications of VAR. What are applications of VAR? To set risk limits, to help in minimizing losses. It can be used in banks, it can be used in security markets, it can be used in capital market. Bunch of this stuff we all discussed, right? So if you overall basis, right, other than 1 or 2 small tricky questions, which tricky adjustments, that 2 last line adjustments in some of the practical questions, and probably 1 odd question which you may not, which may not have been in your zone when you were actually preparing for theory questions, I think the paper is fairly easy. I wouldn't even call it average or medium. I would actually call the paper as fairly easy. See, every paper will have some 1 or 2 small twists. In this paper, the only twists are in with respect to the ALM question, or with respect to one single last adjustment in some of the questions. Beyond that, there's nothing else. So I strongly believe that this is a fairly decent question paper, and I students who have studied from OneFin, I'm pretty sure that they would have done very well. So I further suggest that if you're watching this video during the exams, it is you shut the video here and go back and study the next subject. If you're watching this after the exams are concluded, then then I hope you've got a good understanding of how we how the examination pattern is and what kind of questions are asked, and you would have realized that most of the questions are asked from are what we discussed in the class. This has been the case for the last 2 to 3 attempts. 3 attempts ago only, there were a couple of questions which were slightly tricky, twisted, and tough. But otherwise, last couple of attempts, actually the question paper has been fairly simple. Okay, chalo. So now, without further ado, I want to leave you guys, and please start preparing for your next exam. Okay, chalo. All the best.